If all you cared about was cash on cash arbitrage, using whole life insurance is not something that you should do. So then the question would be, oh, you got me. Why in the world would you use whole life insurance versus something like this? Cameron, welcome to the BetterWealth show.
Thank you.
So what we pride ourselves in is having people that agree or disagree on the show, talking about their experiences. And you've made a couple comments, and one of the things that caught our attention is you've worked on the inside of some mutual whole life insurance carriers. You've also seen firsthand infinite banking, maybe the good, the bad, the ugly. And I know that you don't 100% agree with infinite banking, how it's been sold. And as an insider, wanted to come on, share your experiences. I know that you gave me an outline as well, but what I would love is to get a little bit of your backstory. I'm talking like 1 or 2 minutes. And then we can dive right into the con/risk of whole life and infinite banking and dive in from there. And so if you just want to give your name, where you're from if you want to, and then maybe your background as it relates to insurance, I think it's important for people to know maybe what gives you the potential position to be able to speak on these things.
Right. Yeah, well, thanks for having me. I do appreciate, being able to kind of share my side. I never really thought I would be kind of going into the YouTube world and sharing. So, but yeah, my name is Cameron, and I recently got out of the business. It was my first career, but I was with a lot of different insurance companies, or a handful, for about 11 years. And I really seen, like, I got started as a telemarketer for about a year. Then I switched to account management, policyholder services, underwriting, a little bit of accounting and administration. So I really got to see a lot of different things, and I'm fortunate to be near a big city. I'm just about 30 minutes north of Chicago. So there's a lot of insurance companies here, and so that kind of how I got my foot in the door with insurance. And, personally, I was kind of climbing the corporate ladder for a little bit, and then I think I got to a point where I'm like, it wasn't that important to me anymore, and I just kind of want to look for a different career. But as I was getting out, I noticed that, more in the social media, that a lot of people were talking about life insurance. And so it was just, it was very fascinating to see people very interested in something that I've been working in for so long, and just, on some level it could be boring or just not exciting. Yeah. I'm like, oh wow, people are like really into this, and they're saying, things that, like, not necessarily wrong, just like, oh wow, that's, they're just, it's always interesting, like, when you see kind of a community be like really intrigued with a job that to you it's just like a job.
Yeah, and one of the things that you wrote in what you've said to me is you use the word overemphasize and exaggerate, which I don't disagree with, by the way. That's when we popped on. I was like, hey, listen, like, I'm coming in super open-minded. Love these conversations, by the way. Probably one of my favorite is just have conversations with people that maybe don't agree on everything, and I think there's so much we can learn. But I agree with you that not just in this space, but in the index universal life space, in the crypto space, almost pick any space, you probably can find people that over-exaggerate and overemphasize things. And I think that's very problematic if people are putting their money, or if they're putting a big portion potentially of their financial life is in maybe an over-exaggeration. So with that, did you get into insurance just because you wanted to climb the corporate ladder, or did you like the concept of insurance?
How I got in, or the idea is that my dad's been in insurance for 30 years, and he's close to retirement. I mean, he's been very much on the corporate, like, marketing side. And so it was my first summer, like freshman year, college. And so I just needed a job. And so, I had a job at a local insurance agency, someone my dad knew. And then I went back to school, and then just, eventually when I was kind of figuring out what type of job, I just kind of went back, and then I stayed with it because I was doing well. And then eventually I got other jobs and was able to build a resume. So it wasn't necessarily something I was looking for initially. And then when I got in, I just kind of was building a network of people and just seeing a lot of different jobs and just a lot of different opportunities. So that's really how I got into it.
And you work, do you want to share the different insurance companies that you worked with?
They're
different companies that have done whole life and infinite banking, and it's my understanding that you've seen how these things actually work on the back end from a home office perspective.
Yeah. So I'd say kind of on the bigger spectrum, people would hear of State Farm, New York Life, people that maybe more focus on just like life insurance. They might heard of Illinois Mutual. There's a small one called Elko, and then I was with Mass Mutual for a little bit as well.
And when you say with, you were actually at their corporate.
Yeah.
So you weren't necessarily meeting with people selling insurance. You were.
No. I was in like their Chicago office, and then working remote, but more associated.
I would have all those companies. How many of you have seen quote unquote infinite banking? Because State Farm, well known, but I don't think they promote.
No,
I mean they have a whole life insurance product that I don't think anyone's super thrilled. Like it's never talked about as being like super competitive, and I've never seen someone at State Farm promote the concept of infinite banking.
Definitely not. They're more like sometimes people would call in, or even agents being like, "Hey, I heard of this. Do we have anything?" And it's like, so no, they really did not have anything like that. But the other carriers, they did, because they had these paid up additions riders, and that's fundamentally how like infinite banking or overfunded whole life work.
Okay, well let's jump into the overemphasize / exaggerate upsides and downplaying cons. Why don't you just give your initial thoughts around? I mean, you've been in the space 11 years.
Sure. And what I want to say is that I more to consumers that are watching and thinking about this. It's more of that, because of course agents they know a lot of the lingo, so there's obviously going to be some things I say and explain, and it's not because I know that you don't know the answer, just for the consumers watching.
Yeah, I appreciate
So I don't even think that, I'm not really coming from the side of like, oh, I think this is a bad product and I'm sharing from like, this is why it's a bad. I just think with anything that there's pros and cons, and that sometimes from an agent, they can't really share like the cons from an unbiased. They could do their best, and I don't think they're really supposed to. I think there's nothing wrong with saying like, this is the best and why I think it's the best. It's just that you hear a lot, even agents, they would send, because I did a little bit of agency support, so I got familiar with quoting, and so people would call in and they would say, this is the type of quote I want, and this is how I've been marketing it. So you would hear like a lot of things. I would see pitches like, imagine if there was a savings account with a guaranteed rate of return. You never lose your money. It grows at least 4%. It has creditor protection, upside potential. It's a bond alternative. It's your emergency fund. It's your opportunity fund. It keeps, estate funding, so no one goes after your money. It also has long-term care funding in it. So you hear a lot of like this language of, all the upsides it could do. Oh, it's a college savings account. So like you hear all of that language and you're like, well, what does that, actually mean? And so, yeah, I mean, I think just kind of, when you look at some of like the cons of like, well, how is it really an emergency fund, and comparing it to like a savings account, because like you have different things. So like with insurance, you have a required premium, and it could take years to break even. So depending on how you structure it. So I just think that when it's like, oh, this is a great savings account, and then it's like, well, you break that down, like there's premium involved that's required, and it's not like your savings account, like at a Chase, where it's like, okay, I stopped paying my savings account. I still have my savings account. So I don't know, just that's kind of some of my gist of like, there's the pitch, and then kind of breaking down like, what does that mean?
Yeah. So let's dive into, first of all, structure. When you structured policies, what type of, like, what were like the first year liquidity rate? Like how much cash value would be in a typical policy that you would see of people that are doing this? and then we can unpack all the things that you talked about. I'm just I want to get an understanding of like how you design policies or your understanding of max funding life insurance.
Yeah, I mean the ones I seen, like whatever department I was in where I was looking at policies, a lot of it was a base policy, so it was very much going to the totality of the policy. And so I mean I think that, you know, whole life where it's different from term, you know, term is just a pure cost, and then when you have whole life, there's really two components that I don't think people really think, you know, how was this created? Like, you know, how is the sausage made, so to speak?
Well,
So,
and in whole life, how would you design, like, what would be like the base, which would be required premium, versus like the PUA?
so I would say for agents doing that, you know, you might see like a base of 3,000 and then the PUA like 7,000.
So it's like like a 30% base.
Yeah, you would see that. And then, you know,
and what would typically be the break evens back when you design policies?
I mean, it really depends. I would say if I were to just give like an average, I would just say maybe at like the 7-year mark.
Yeah,
because I've seen it earlier. I've seen, you know, 3 or 4 years. I've also seen 8 or 9. So that's why I just said 7. I think like 7 was really like where you see like the pure break even.
Yeah, and your big problem is that, you know, people would like pitch these. Would they pitch it as like a amazing investment, or you'd say they just pitch it as like this amazing savings account? But really, it's a savings account has different pros than, like, there's different pros and cons.
And here's the thing, Caleb. I'm not in those sales appointments. You know, I'm not.
Yeah.
I don't know how long they worked with a client, or you know how many hours or what they told them exactly. Because you know, someone could watch your, you know, like the game of telephone. Like someone could watch your content, be sold on it, buy a policy from you, and then they're communicating with their friends about how awesome it is, and then they could say something like, "Oh, this is the best, you know, investment you'll ever make."
Right.
And so you didn't say the word investment, but they interpret it that way because, you know, they heard asset, and then you use this to borrow against money, so to speak. And so when I worked in policyholder services, that's where I would get a lot of phone calls. And so I would get, you know, a lot of people that were wanting to cancel their policy or cancel it, and for different reasons. And so I want to focus more on people that had these overfunded whole lives versus UL and base policies. So there was quite a few people that when they wanted to cancel, I was led to believe that this was a pure savings account. I was led to believe that this was a savings alternative, the way maybe like a money market is an alternative. And so there's just like a lot of, you know, there's just like kind of a lot of problems when it comes to, you know, people that bought this, and then they were, you know, they're asking me, and I'm seeing what I could do as far as flexibility. Like, okay, we could take off this rider, and then this is what you owe. And then when they're said, well, I was told it was flexible, they're thinking flexible the way you and I could be flexible with our checking and savings account. Because we decide what goes in and what goes out. And so, it was very, you know, disheartening to see that. And then, you know, I mean, I'm not like the compliance department. So sometimes if someone wanted to make a complaint, I got, you know, and I can't get involved with the agent because that's just not my role. And so, you know, they said, well, my agent led me to believe this is really how it works, and that, you know, it's my fault for not managing loans or managing premium. And so I just thought that was not good. And so that was a common thing with the overfunded. Sometimes people were happy about it. What I found, like, the people that were most happy about cash value were the clients that didn't know they had it or didn't understand it. So they would be saying like, "Oh, I'm thinking about doing this or that." I'm like, "Well, while I am on the phone, this is your cash value." And they're like, "Well, what do you mean?" I'm like, "Yeah." And they're like, "Oh, wow, I thought that's..."
You're not sold the moon, and then you get surprised like, "Oh, I have cash value that I could utilize."
Yeah, it's very much like finding $20 in your pocket after doing laundry. You're like,
Yeah,
oh,
that's actually very. I think there's a lesson that can be learned from this, and here's the lesson: is don't over pitch something, and in a way, this is insurance first and foremost. And if you're trying to sell it as other than insurance first and foremost, that's a problem. And if people don't value the insurance aspect, they don't value long term what a permanent life insurance policy could do for you, then infinite banking or whatever you want to call it, bank on yourself, cash flow banking. I wrote the book called The And Asset. Whatever thing that you want to call it is falls flat if you don't value insurance as insurance. And I think one of the biggest problems that I see in the space is people, and I've done this in the past as well, almost like undersell the insurance so much where you're like, hey, I don't even care about the death benefit. I just want these for the other benefits. And you could make the argument, even if the death benefit went away, there's still other advantages to that. But I think it's like, I think we all do ourselves a disservice, and then it maybe expectations are maybe high. And if there's anything that I think we need to do a better job, it's like talk about the principles and then ask the question, what type of asset classes help check those boxes? And here's the negative thing about using permanent. We'll just use whole life, for example. The negative thing is it's not as flexible as a savings account or a checking account. That can be a negative thing. That can also be a positive thing long term to be a forced bill. But we'll say that's a negative thing for this point. Now, my caveat to that is how you structure a policy matters. And you can structure it way more flexible than 30% base, but so I think there's how you structure it that matters. I think the expectations of how much cash value you borrow against also matters. Something that I'm not a big fan of getting people to use their policies, or make them feel like they should use their policies for all these kind of things. That's a question I want to ask you about some of the crazy things that people would call in to want to use their policies. I think that's something that's not good for the insurance companies, not good for the consumer if they're like looking at it like a bank. But we wonder like why people do that. Well, when you call it a bank, or if you compare it to a savings account, that's maybe why people are trying to buy groceries with it. And so like that's number one. Number two is it takes you, in your case, 7 years. It can take 7 years. We've had policies, break even in year 3 or 4, but it could take, a couple years before you have more money than what you put in. And so when you compare that to a high yield savings account, you have to understand from a cash value, like access standpoint, you have more money in a savings account. We'll just say for the next 7 years.
Right.
That's something that needs to be factored in. And if all you cared about is cash on cash arbitrage, which I've said multiple times, should not be something that anyone in infinite banking opens their mouth about, because it doesn't really happen that way. That can be problematic. And then not everyone qualifies. It's actually insurance, and as much of a benefit that could be, not everyone qualifies for that. Would there be other cons other than what I mentioned?
Well, I was gonna mention that I kind of thought of it. I was working in a different office when this memo got out, but the Mass Mutual memo. Yeah. And to me, it was very to me, it was a little comical when it came out, because it was not the state or Fed regulate coming out and like putting, it was more like almost having a parent talk to their kids and be like, listen, we're not gonna be putting up with these shenanigans, because it really was, people were calling in like they were a bank, and it's not a bank. So I mean, and there's a lot of like administrative costs and management to, go over loans. So yeah, it just made me think of like, I remember when that memo came out for Mass Mutual, and they were like, we're not doing this anymore.
Yeah,
that.
They had strong words that were like, hey, we do not want to be associated with infinite banking, because again, the word bank, and like some people, and you and I have probably seen some pretty crazy pitches where it's like, wow, it's like they you're really looking at this like a bank account. And some people teach that like all your money should flow to this, and they get super aggressive early on. I'll tell you another thing that I'm not a fan of is when people try to be super aggressive early on and try to give as much money to flow towards insurance. And again, like I'm a huge fan of life insurance, huge. But I have it. I don't try to like overhype it or overemphasize it, and I feel like that is very problematic when you do that. And I understand the product, and when you're working with somebody who has maybe a less of understanding, it's our duty to make sure that no safe product is positioned to put them, i.e. your client, less safe. So in other words, some people design these safe products, but the way that they have it funded, create it where they like need to fund each year these high premiums, and if they don't, then their policy could be at jeopardy, and then they're max loaning out their policy, which also loses a lot of flexibility, because if you have no ability to loan against your cash value because it's all loaned out, and you have these big premiums, you're 1 bad or 2 bad years of income away from potentially losing your policy. And that's something that I think we're going to see more of from people that have aggressive funding strategies.
And I think the aggressive approach, where it really hurts is because where I will see or hear about agents kind of going through the cons or the downside, or what can you do for the downside, is that they over promote the reduced paid up plan, or they over emphasize the you could take the PUA rider off. But when you do all that, it does reduce all your benefits. So
it reduces the death benefit, and obviously your cash value is going to go lower than what it would do if you keep funding it.
But also, Caleb, I think people don't, when they're going through kind of the pitch I was saying that I overheard, they go through all that. One thing the pitch is about critical illness or like living benefits. When your death benefit goes down, also those critical illness benefits goes down. So when you're over emphasizing someone, borrowing against their policy and a deal goes bad or goes south, or it takes longer than what's expected, and then they're in a position where they might have to, do reduced paid up or take some of the riders off. It does, that selling point that when they sat in front of the agent and they were told, oh, this is your long-term care fund, this is the bond alternative, suddenly that, whatever, the total 6 hours you spent with the agent, it kind of goes out the door, because I'm leveraging this, I might have to reduce it. And then that means that, the cancer, the heart attack, stroke, all those living benefits, they get reduced too. So I think that's where that's problematic in the pitch, because, suddenly it's not this policy that's doing 3 different things. It's a policy that's doing 3 horrific things. And
what do you mean 3 horrific things? Because a reduced paid up is when you don't want to continue to pay premiums, and a lot of times what you do is you have your death benefit, you have your cash value. When you reduce pay up, the death benefit drops pretty significantly, and then no more premiums are required, and every year your cash value and death benefit still increase. But what you're saying is the death benefit dropping, there's other consequences for. Instead of having a $5 million death benefit, you have $1 million. That's just an alleged example, but there's obviously consequences for that. But what do you like? All those benefits are still available.
Yeah. But it's more like you can't replenish it. So what I mean is once you exercise unfortunately, if someone has a heart attack, they use that and it's great, but then suddenly, because it's being exercised from the death benefit, all that premium that was going into the cash value, all that reduces. So then suddenly this one policy really isn't still performing as, the savings, the emergency, the critical illness, the legacy. It's kind of everything is being reduced, if that makes sense.
Yeah, I
So
guess
I think
yeah, I guess unpack that a little bit more because, and again, maybe you think I'm crazy. I think as long as people understand that cash flow is cash flow, and if you're putting $1 into a life insurance policy when you're in your 60s and you have $3 or $4 that increase your cash value, part of me wonders why you would stop. But some people may want to stop just because they don't like the mental aspect, that they don't want to fund other things after a certain period of time. But reduce paying up is not necessarily the plan. It's just an option, and I think it's a good option. And it's almost like you're like, hey, if you reduce pay up, there's some negative consequences that come with that. My hope would be before someone pays up their policy, they would know the pros and cons between like, hey, I'm not going to be funding anything more, and for obvious reasons, the death benefit is going to come down. Yes, there's going to be some other things that maybe will be off the table because my death benefit comes down, but I don't have to pay any premiums ongoing. Yeah. I'd be paying premiums actually as a good thing once your policy is humming, but not everyone sees the paying premiums as actually a contribution. They see it as an expense. And so I guess unpack.
Yeah, that goes back to the individual, because I think, their savings goals and plans are different over time. So, I might have a certain number set aside, maybe it's $30,000 or $40,000, but as I get older, that need changes, or I'm setting money aside for savings and then setting that for investing, because when you really get to the distribution, you might just want to be more in I just want to spend my money and enjoy my money, or I don't need that buffer for income because I'm in retirement, or, maybe I'm living in a retirement home and I don't need that buffer to buy a car because I'm not really going to drive that much. So, I don't really think like the reduced paid up is bad. I just think that sometimes people might be in a position where they have to do that, like I said, where more like an investment is going wrong, or they actually lost money on investment. Yeah. So now they have all these, they have to deal with the loan, the compound interest on a loan. I don't think most people really understand the loan aspect, and that it does compound.
Yeah, loan interest compounds if you don't pay it. Plain simple. It's like any decision that we do compounds with time, and that's another thing that I think it's misspoken or mispitched, is they almost make it sound like your cash value is compounding, but your loan interest isn't, and that's not true, because after it will compound if you don't pay the interest. Right. So I think a better way to just talk about it is you have an unstructured loan, you have options, but sometimes options aren't great, and it can allow you to maybe not make the right decision. And instead of paying back that loan, you're buying something else that maybe is not an asset. And now your whole life insurance policy is enabling you to make bad decisions. It's not the whole life policy's fault. It's your fault, but you have an asset that isn't more enabling than maybe if that money was locked up.
Well, and that's where I would go into some of the agent tactics where, it becomes kind of blaming the customer and like, well, you didn't use your policy correctly, and now, they changed their mind on the philosophy of infinite banking, and then they did buy liabilities, but then they have this, this policy, this loan, and all these other issues where, if things go bad, like, it's not very empathetic. And I'm not saying you're doing this, but the agents, like, it's not very empathetic for the agents to be like, well, you're not doing it right, because we know the MLM culture of like people that failed out of the MLM, and then it's like, well, it's not the MLM's fault. You just didn't, want to do things. That's where the risk comes.
Yeah, let me draw something, because I would love to honestly get your honest feedback on this, and then you can kind of give your 2 cents, because it's very similar to maybe part of the pitch that you were saying that you don't like. Let me share my screen. So this is something I've used this drawing a couple times. Is all right. This will be you, Cameron.
Hello.
And, Cameron, number one, you have money and you could invest that money. I mean, technically, hold on. Let's just say your dollar can do two things. It can either be spent or it can be saved. Okay? It's either spent on taxes, coffee, lifestyle, computer. It's like this is lifestyle. This is like cost of living your life. Say money saved, this is obviously a verb. Hopefully the money saved, set aside, is invested. And you could invest in stocks, real estate. You could, you could invest in whatever you want,
Right, sure.
mutual funds,
Whatever.
anything. Okay. And then the hope is that this portfolio over here will kick off enough cash flow someday to be able to finance your lifestyle. And obviously inflation's a thing. So but that's would you agree that that's kind of like retirement planning 101?
In general, there's spending and saving, and then, whatever, saving for investment or saving just to save, yes, for sure.
Right. But would you agree that the money that you set aside hopefully earns enough that you can ultimately not have to work actively, but this money will kick off enough for you to be able to live your life?
Yeah, I mean, absolutely. That's why even for me, I'm fortunate where I'm, I left my job and I didn't have to run to another job immediately.
It's great. All right. So now this is the life insurance version of that. Same thing. You spend your money saved. Okay. Now, instead of investing directly into, let's just say real estate or the market, what many people, and this is, I would include myself in this, one of the things is what if we directed some of the money into a life insurance policy? And when we talk about max funding a life insurance policy, I mean, we're really nerds about this. I think you could create I think if you're going to do this, if you're going to structure a life insurance policy in a way that has cash available, make sure you understand the economics, the pros and cons of that. But so you fund it, and I'm drawing two lines. I'll do E and O. E stands for emergency, and O stands for opportunity fund. And with that, I'm very proud of the many clients, and I'm included in this. I'm proud of the fact that most of our clients don't utilize loans, and that might be crazy for people to hear, but I think they look at this maybe as a protection asset and a safe asset when it comes to their portfolio. And we take the E for emergency really seriously. And it's you figure out what that is. For me, it's pretty aggressive. I'm pretty aggressive with emergency funds, meaning for me personally, I want over a year of personal expenses, and in the business, I want a year of business expenses.
Oh, yeah.
People might say, why? But it's I am able to run a great business and not be so jumpy because I know that we have capital. Now, I'm choosing to have this money in life insurance. You don't have to, but I'm just choosing to have it stored here. But then anything above the E, opportunity, I would look at is O for opportunity. And the O for opportunity is just where you want to utilize your money. Now, there's a difference between an asset and a liability. We don't teach, if you're going to borrow against your life insurance policy, and let's just say the cost of borrowing is 5%. If you do anything with that borrowed money and make less than 5%, you are literally losing cash. So if you're borrowing at 5 and earning a 4% rate of return, yes, your money's compounding over here, but you literally lost 20% on that activity. And so it's really important whatever you quote unquote borrow, that whatever activity you do, you have to understand the return, and you also have to factor in risk and factor in what if it doesn't turn out? What if you have to factor all that stuff in. Right. And you have to make sure that whatever you're going to use your policy for is earning a way greater return than what it's costing you to borrow, because not only is it costing you to borrow, but you're losing some liquidity. And that can be problematic as well. And I think this is where a lot of people fall when you teach people to buy cars or go on vacations or pay off mortgages and all. It's like, listen, if you actually look at the math, I don't think it doesn't add up when it just comes to pure math. And people will say, well, the flow of cash and all that stuff. And it's like, no, listen, like that's also, the math does not add up, even when you talk about flow of cash flow, because you can't justify a bad financial decision and say, oh, on the back end, I'm paying myself back, so it all makes sense. It's not true.
Right.
So I want to hear your thoughts here, because obviously I'm looking at this as even if I can earn a greater return outside the policy, a lot of times I don't, because I value control and liquidity more than what I could be making. But then this same policy creates an umbrella, and that's the insurance aspect of, like, there's insurance protection and other benefits as well. What problems do you have with that way of just explaining big picture of, like,
I guess
where an insurance policy could fit in someone's financial life?
Yeah, I guess I don't have a problem with it, because I don't think it's, neither bad or good. And I think, sounds like you do a good job explaining people the pros and cons. I just think that usually, like, with scenarios in general, that, there's scenarios, there's like the reality of what people are really going to do. So, and not to go into like the alternatives, but it's no different than if I opened up a brokerage account and, let's say, I did tax exempt money market funds, because I even checked recently, like with my brokerage, and they said, well, because this is money markets, we would allow you 95% access to borrow. And I think my rate, I wrote it down somewhere, but they were like, 2.39. And right now I'm earning like 3.4. So again, I'm not really going into like, there's alternatives, but I'm just like, I think this is fine, but there are also like other ways to do things where if you just saved money, you wouldn't need to look at like, okay, there's 5%.
Let's talk about that. Let's talk about that next. Let's talk about that next.
Okay, sure.
Let's talk about two things. First thing I want to just say is, if anyone's talking about infinite banking around this part here, I think you got to be really careful. And I think this is where a lot of problems come up.
Right.
When you're teaching people how they use insurance to better spend, the only way the math works is if you make more money over here. And I think it's financially very problematic to especially be pitching this to people that aren't sophisticated, especially because majority of the people that you're probably working with were maybe not like worth 50 million, they're probably like, hey, like, this is, I was not aware of this. And so I think a lot of problems in a lot of different areas break down when you're trying to help people use infinite banking or life insurance to better spend their money. I think that's very problematic. I think one of the reasons is, if you look at insurance as an asset and look at it as a part or the foundation of how you save and invest your money, I think that's interesting. It's not an investment, but it's just like how the flow of that is key. Now, you said the other thing, there's other assets out there that you could save and leverage, right? So you use an example of, you have a savings account, and we'll just say versus, whole life. And you said your savings account earns over 3%.
Yeah, it's basically a savings, but it's money market, but these are tax exempt money markets, so almost like a.
When you say tax exempt money markets, you mean like, at a bank account, it's tax exempt?
No, I mean, this is at a brokerage, like Fidelity. Okay. But I mean, it's very liquid. It functions almost the same.
But you're saying it's tax exempt, so you don't have to pay taxes on the interest?
Mm-hmm. Yeah. Yeah, they're
but you're earning what?
So it's been, I think this year it's like 3.5. It's been higher before, but
right.
About tax exempt funds and bonds.
Yes, but the devil's advocate could be, you can earn right now similar 5-6%, but you'd have to pay taxes. So is it fair to say that whether it's you're earning 5% taxable or you're earning exempt, but obviously you're not earning the same of what someone would have to pay on the tax side.
Oh,
So
sure.
let's say you're paying 3.5%, and you're saying in this case you're able to borrow money at less than 3.
Yeah, like 2.39. Yeah.
Okay, so 2.39. B for borrow, and then E for earn. I'm sure I'm annoying lots of people in my drawings. Okay, so we can agree that this, from an arbitrage, this technically in this snapshot, you arbitrage your money. You're arbitraging,
Yeah.
earning more than what you're borrowing. And so you could look at this, and you could be like, okay, this is actually, all we cared about was arbitrage. This is a more positive arbitrage than what you get in a whole life insurance policy. Period. Like straight up. Like if you're earning, let's just be generous and say that you're earning 4% internal rate of return on a whole life policy. With interest rates going up, that might be higher. But again, with internal rate of return, you got to wait 15, 20, 25 years. Internal rate of return. Right. So let's say you're earning 4% internal rate of return. And you're, 4 or 5%. And let's say the loan is 5 to 6%. So literally, there's no, from an arbitrage standpoint, if all you cared about was cash on cash arbitrage, using whole life insurance is not something that you should do. And those of you that are watching that are like, that's why I do index universal life, like I would caution you on that as well. Long term, don't think that it's going to pan out maybe the way that you think it is. So then the question would be, oh, you got me. Why in the world would you use whole life insurance versus something like this? And the reasons I would still use whole life versus this are all the benefits that I get. It's not just I don't just put my money in life insurance for the cash benefits. There's so many other benefits that I get with whole life that I don't get with savings accounts. And so you may agree or disagree with me, but when you start checking all the boxes, and this is the same thing that you were like, sometimes it gets overhyped and overpitched, but it is true that whole life gives you a lot more benefits than a straight up savings account. But there's some other cons that we talked about early on in this, like savings account is more flexible, technically. You get earlier liquidity than in a whole life insurance policy. So there's cons. You don't need to apply for insurance, whereas this, you need to get approved. But once approved, there's other benefits that whole life gives you. And It's my belief, when you actually value those benefits, that while there's not cash on cash arbitrage, there's value, there's financial benefit over arbitrage. And I believe that is far greater long term than what you get in the savings account. So in the short term, savings account wins if all I care is about cash on cash. Long term, whole life, when structured properly, I believe is better for somebody if they can see past the few cons and that they're not over leveraged by trying to fund insurance. I want to hear your thoughts, but I just wanted to like lay out that dynamic because I feel like there's a lot of people not speaking that properly. But I also literally am sharing with you why I still am a fan of whole life, even with it not being cash arbitrage.
Yeah, no, and I love insurance. I mean, I've had all types of it. There's definitely a place for it. I kind of feel bad because I wasn't trying to, do like I got you. I just more like there are like, there's alternatives. And like I said, I didn't want this to be a strictly alternative. Because for me, I don't think I would even though I could borrow, and I really did call just to, because I'm like, I just want to have the information because I was planning to bring it up and I wanted to see, and so they said like, yeah, your interest would be 2.39. And I believe there are other benefits. And I think with that, if there is a need or desire, however, I know some agents are like, oh, like I don't need life insurance. I want life insurance to protect my family, but it's kind of irrelevant, like the need or want, or like if you have it because you think you need it or want it. Because there's also there's convertible term. There is term to age. One of the companies I worked for, they had a term to age 65 and a term to age 70 that was convertible. And so those are scenarios where and again, this is not really like, I want to come up with alternatives, but if you wanted to go the route of like, okay, living benefits term to age 65 and it's convertible with the brokerage account, could that be whole life because it's more flexible? Because I guess, I realized for me, I do value the ability to contribute and stop saving anytime I want. And if I do, feel like I need more insurance than I have, because I actually had an overfunded whole life before. And it was kind of when agents were calling in about these IBCs, I eventually got one and I did it in-house. So there was no commission, and I actually like broke even like really quick. So I'm like, oh goodness, like, man, I don't know if they did that just for like home office employees, so, or whatever. But then I even used it. So I was able to, I did lend it out. It was a family member. They were doing like a short flip or something. So they're like, hey, I just need to hold on to some money for a reserve, but I'll pay you percentage back. So so for fun of it, I did it through a policy loan. And then 2 months later, got the money back, paid back the loan. And then I had kind of this aha moment. And so the aha moment for me about like IBC, not even just IBC, but the overfunded whole life to buy assets, I had it after I got the policy, because before I've read the Become Your Own Banker, the Nelson Nash, like I've read the little booklets about how the wealthy use life. And so all that to me like intrigued me enough to be like, let me do it. And then I did it. And then I did a deal. It was a quick deal. I got the money, paid it back. And then I guess I had this aha moment of like, oh, it wasn't that amazing. So not that it was bad. It just, to me, it wasn't that amazing. And then I thought of my lifetime, the longevity, like, do I want to, do this, have this premium and structure? And then it just became something I just wasn't as excited about. So
Yep. You canceled it?
Yeah, and I'm luckily I got all the money back. So again, I don't know if it was like a home office employee thing or something. They're like, we don't want to employees.
The a couple of thoughts. It's just, it sounds to me that you don't value whole life insurance long term. Like or it didn't move the needle for you, because it's like you literally just shared how you funded a policy, you used it, you got the cash, did the deal, did the flip, was it successful? You got your money back.
Mm-hmm.
Were you able to make money on the flip?
Yeah, I did.
All that work, and you were like, hey, I'm not thrilled about pretty much funding this insurance policy long term, but it ultimately, and this is not a jab to you, but you just made a decision that you're like, I don't value the long-term benefit of whole life. For me, I would rather have it in other accounts, like savings accounts, and like, is that a fair breakdown?
Yeah,
you'd only want to do whole life if you actually value what it could be long term for you, and some people do, and many people don't.
I would say the reason why I didn't. So this was couple years ago. April I just turned 30, so like I was having fun living in the city, doing all this, and as of now, I don't have dependents. I'm not married. I don't have dependents, and then when I was thinking of this policy and kind of legacy, I'm like, okay, if I die now, like I I forgot what they call it on savings account. Like it's not beneficiary, but like paid on death. So it's like a beneficiary for your bank account or investment. So I had all that in place. So I'm like, at the very least, if I pass away, my siblings, my parents, my nieces, it doesn't have to go to the government. But yeah, and that's something that things could change, but like I don't desire to get married or have kids. So that's kind of what led to that as well.
Well, and again, goes both ways. That's a decision that you are making. Mm-hmm. There's probably nothing financially. There's no reason financially people have kids. It's not like someone's going to be like, hey, I have a really good idea financially. Let's have kids. But I look back even on my life, and I'm a new father, and it's been one of the coolest things ever. And so it's not any like, it's everyone has different paths that they want to take. But I think also this conversation, I think, is really going to be important for people to see, because I think we're able to go a couple layers deeper. And again, it makes sense that you might not value permanent insurance with not having desire to not get married and have kids. That makes sense. You can see where maybe I value or other people value permanent insurance
100%
greater when you have certain things
100%.
like, so I think it's interesting, and I don't know if you have any final thoughts, but my hope is, and I'm not sure how these videos are going to do on this channel, my hope is that we can continue to go deeper, and that people appreciate my willingness to have people come on that, I mean, to your credit, you reached out to us and said, hey, I disagree with some of the things that you're saying, and I would love to come on and have a dialogue. And I just wish you disagreed more. I need to find somebody who like adamantly disagrees with me, because I find us agreeing way too much.
Yeah, well, I mean, that's how it is. And so I know I felt kind of bad when, we had this set up, because I'm like, oh, I don't really think we disagree, because a lot of this is more like just risk, just like opinions. But yeah, I mean, I appreciate what you said. And I mean, I have 3 nieces that are young, and I love them to death, but I'm just still at that point in my life where I'm enjoying being young, and like having young people that like, hey, we could play, but also like, you're not my financial responsibilities. So, things could change. And I mean, more, I guess kind of in closing, that not too long ago, sometimes, my dad will call me up and be like, all right, I'm going through if anything happens to me, this is where everything's, that type of stuff. And yeah, there's a lot of, in my family, like, I guess, grandparents, both sets, my parents, there's whole life, and it's because of the legacy aspect. And so I don't think there's any perfect solution. There's only trade-offs. And so I think when someone thinks that whole life and the overfunded, that it's not an absolute good, or it's, the best or worst, financial asset. Just, hey, there's good things, bad things, can live with the downside.
I think in my ending is like, insurance is not an investment. That's probably the biggest thing that people maybe come on and they perceive my position to be like, insurance is the end all be all, and that's not. I look at it as a financial foundation, protection, all. But then the beautiful feature of that is you have access to cash. And if you have access to that cash throughout your life, and you benefit insurance long term, it is pretty amazing. You get the long term benefits of insurance, the legacy, blah 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 blah, and you have access to cash to be able to invest in the things that you care about, or make moves. And so it's not a savings account for the first 7 to 10 years maybe might be better when you look at just the liquidity, flexibility, and cash available. Now, over time, a savings account will underperform what a properly structured whole life, but the disadvantage of that is you got to wait 10 plus years. But the pro is you can utilize that cash, which is a huge benefit. And then the other pro is there's all of these other benefits of insurance that may not benefit you directly, but are beneficial to your estate, to your family. And that's where I find that people that really get it, they like the strategy, but they're not ever thinking that this thing is going to like solve all their financial problems.
Right.
And that's where I have problems with people that overhype it. And I know lots of people that are really, really pro infinite banking, that get driven crazy when they see people over pitching or overhyping or over marketing. And if there's one thing that I would like is to kind of like tone down the noise, because I think it's doing a lot of disservice. So Cameron, thank you for coming on the show. My hope is that we'd love to hear from so many of you, and please make comments on thoughts, takeaways. And if you want to come on and have a discussion with me, please let us know in the comments, and we'll figure out a way for you to come on the show. So, Cameron, thank you.
Thank you.